Hello, and welcome to this lecture on IFRS to share-based payment. We have had an introduction on Friday of this standard, and so this is a lecture to give you a bit more details on the standard IFRS to share-based payment. Your lesson objectives are: after reading IFRS 2, you ought to be able to explain share-based payments, to outline and explain the various types of share-based payment, to apply and discuss the provisions for accounting for equity settled share-based payment and cash settled share-based payment. And of course, every standard comes with disclosure requirements. So again, you have to look at the disclosure requirements under IFRS 2. Now, share plans and share option plans are becoming increasingly common as remuneration. What does that mean? Entities are able to pay for their employees' services by giving them their shares or giving them share options as remuneration, as bonuses, as salaries. So, for example, working with UCC, if UCC is a listed entity and has shares, UCC will decide to pay me with shares instead of giving me cash. And that's what we mean by share plans or share option plans. Now, let's understand share option. Now, UCC can give me its shares. So in this case, UCC is issuing its own shares as payment for my service as a lecturer. On the other hand, UCC can give me share options. Now, share options are the rights to buy UCC shares. They are the rights to buy UCC shares. And why would I be interested in UCC share options? Is because that right will give me the opportunity to buy shares at a lower price than the market price on a specified date. So you need to understand when share options are being given and when share itself are being issued. Share option, a contract that gives the holder the right but not the obligation to subscribe to the entity's shares at a fixed or determinable price for a specified period. So this is UCC giving me the right to buy UCC shares at a fixed price in the future. And why? Because UCC is doing well, its share prices are going up, and we are expecting that even in the future it will go up. But I get the option to buy the share at a lower price, which will be called the exercise price. However, when we get into the future and I don't like or I'm not interested in the shares again, I can decide not to exercise the option. So that is why it is a right but not obligation, right? So some entities issue shares or share option to pay for goods and services from suppliers or employees, either by issuing shares, share options, or incurring liability for cash settlement based on share price. Now, IFRS 2 sets out measurement principles for 3 types, but we are going to deal with 2 types for now. So we have the equity settled share-based payment, equity settled, and then the cash settled share-based payment. And then the third one is the transactions, where the entity or the counterparty has a choice of settling in cash or using equity instruments. Every standard comes with its own specific key terms and definitions, and so, of course, IFRS 2 has its own key terms. I'm not going to explain every term. I'm leaving some for you to find out yourself. So I'll pick and choose. Share-based payment transactions are transactions in which the entity receives goods or services as consideration for equity instruments. So here, UCC receive my service and pay with its equity instrument, or buys an asset, and then instead of giving cash to the supplier, gives its equity instrument. Now, the distinction between equity settled and cash settled. With equity settled, the entity pays with equity instruments. So, for example, we'll issue shares or share options. But with cash settled, the entity will pay cash, but the cash amount will be determined by reference to the equity price, the share price. So that's the difference. In equity settled share-based payment transaction, the entity will pay by issuing shares or share options. But in cash settled share-based payment, the entity will pay cash with reference to equity price. So that's why it is a share-based payment transaction. Then let's deal with vesting. When you talk about vest, it is to become entitled to the provisions of the contract. Share-based payment transaction, the contract. I agree with you that I will provide a service and you pay me with your shares. Now that is a contract. If there are conditions, then when do I become entitled to the provisions of the contract? So that's the vesting, to become entitled. And under a share-based payment arrangement, a counterparty's right to receive cash or other asset or equity instrument of the entity vests upon satisfaction of any specified vesting conditions in the contract. Now, vesting period will be the period during which all specified conditions of the contract must be satisfied, of the arrangement must be satisfied. And the date, vesting date is the date on which the counterparty can collect the cash or collect the equity. Then we have the grant date. Grant date is the date on which the entity and the counterparty enter into the share-based payment arrangement. The date at which the entity and the other party agree to a share-based payment arrangement. Grant date. So if today is 1st January and we enter into the agreement today, 1st January, the grant date is 1st January. Then we have vesting conditions. Vesting conditions, they are the conditions that are supposed to be met or satisfied by a counterparty to become entitled to the provisions of the arrangement. Vesting conditions include service conditions and performance conditions. So you have to understand vesting conditions as being the conditions that need to be met, and they are either service conditions or performance conditions. Now, service condition is, for example, I'm working with UCC and I'm supposed to serve with UCC for 3 years in order to be entitled to the arrangement. And then, so that will be the vesting condition. The counterparty is required to complete a specified period of service before being entitled to the provisions of the arrangement. Now, there is performance conditions, and performance conditions may be market conditions or non-market based performance conditions. So there, for the rest, try and understand it. Read something for yourself. Recognition. The entity should recognize goods and services as and when goods are obtained or services received. So if they bought a building, they will recognize PPE, building. If they bought inventory, they will recognize purchases, inventory, debit, and the credit then will be the shares that have been issued, or they will recognize liability for the cash that will be paid based on the share price. Let's zoom in on equity settled share-based payment. Equity settled. So here, the entity receives goods and services in exchange for its equity instrument. The entity will recognize the goods or services as they are received or an asset, and the corresponding entry will be other component of equity. So debit asset or debit expense, and credit other component of equity, the equity being given instead of cash. How do you measure the value? If they are goods, then you have to directly measure by reference to the fair value of the goods or service being received. But if the fair value cannot be determined, then you refer to the fair value of the equity instrument granted at the grant date. And that may be the market price, or you may use a valuation technique to arrive at the fair value. At your level, normally the fair value will be indicated in the question. Now, the total transaction may be accounted for immediately. What that means is there is no vesting condition. Because if the entity does not ask you to meet some conditions, then it means when you enter into the transaction today, you recognize the transaction today. But if there are vesting conditions, then the total transaction must be spread over the vesting period. So if I'm to stay with the entity for 3 years, then as I work, then you are recognizing the expense and crediting equity over the 3 years. That's what it means. Transaction with employees. Measure at the fair value of the equity instrument granted at grant date. The fair value is never re-measured. It's an equity instrument. Once you do the first recognition, there is no re-measurement. The grant date fair value is recognized over the vesting period. So it is the same fair value at the grant date you apply under equity settled share-based payment. Transactions with non-employees, which means suppliers, measure at the fair value of the goods or services received at the day the entity obtains the goods or services. And if the fair value of the goods or services received cannot be estimated reliably, then measure at by reference to the fair value of the equity instruments granted. Now, this is a summary of everything I'm saying about the measurement and the equity settled share-based payment. So you must identify equity settled share-based payment and know how to recognize and measure under equity settled share-based payment. Like I said, no further adjustment is made once you are done with recognizing over the vesting period. But where there is modification, you continue to use the grant date fair value. However, in case the modification leads to an increase in fair value, then only the difference will be recognized. The rule is that the employee must not be worse off because of a modification. So if there's a modification and it will benefit, it's an increase in benefit for the employee, then recognize the extra benefit. But if it will make the employee worse off, then you must stick to the grant date fair value. Don't recognize anything that will make the employee worse off. Now about performance conditions. So we have market and non-market performance conditions. Non-market conditions. Non-market conditions such as length of service, profit targets, earning per share growth are taken into account in estimating the number of options which will vest, and they do affect the expense recognized. If no options vest, no net expense recognized. Now, market conditions. So we are talking, the first one is non-market conditions. With market conditions, which are target share price or exercise price, they are taken into account in calculating the fair value of the financial instrument issued. Failure to meet market condition does not affect expense recognized. And you have to recognize that non-market conditions are internal conditions. Internal conditions, length of service, profit targets, earning per share growth, they are internal conditions, but market conditions are external to the entity. Okay. Cash settled. So we just finished with equity settled. Cash settled. Cash settled share-based payment transactions occur where goods and services are paid for at amounts that are based on the price of the company's equity instrument. So here, again, UCC will receive my services and will pay me cash, but will determine the amount by reference to the price of the UCC equity instrument. So it's cash because I'll be paid cash. But why is it a share-based payment? Because the cash I'll be paid will be determined by reference to the share price of the entity of UCC. So the expense for cash settled transaction is the cash paid by the company. So an example of a cash settled share-based payment is share appreciation rights. Share appreciation rights. There is a right that is given to the employee for working so hard for the share prices to appreciate. Share appreciation rights. Employees become entitled to future cash payments based on the increase in the entity's share price from a specified level over specified period. So within 3 years, you have helped for the entity's share price to increase from 2 cedis to 5 cedis. Your work, your input, and therefore you are being appreciated by being given some amount of money, and that money will be determined based on the share price. Measurement, you debit profit or loss or the assets and credit liability. And credit liability is money, it's cash. So it's a provision to pay cash, and therefore it will be a liability. The first one, equity settled, is a provision to give shares. So it is an equity instrument. It's an equity instrument and will be recognized in equity. For liability, which is under cash settled share-based payment, there will be remeasurement of the liability at each reporting date and spread over the vesting period. So that's the huge difference between equity settled and cash settled. You will remeasure the liability under cash settled share-based payment, but with equity settled, no remeasurement. Okay, again, this is just a summary. The third one, which we are not focusing on now, but just to give you an insight, is share-based payment with a choice of settlement. Choice of settlement. Here, the entity has the choice. If the entity has the choice of whether to settle a share-based payment in cash or equity, then the accounting treatment depends on whether there is a present obligation to settle the transaction in cash. Okay, I don't want to go too much into this because we have to deal with equity settled share-based payment and be comfortable with it, cash settled share-based payment and be comfortable with it before we talk about choice of payment. So you read for the fun of it for now, and I'll come back and explain it further. So I'll end the discussion here. Define share-based payment transaction. Identify the two main types which we are dealing with at this level: equity settled, cash settled, share-based payment. Read on how to account for transactions under equity settled and how to account for transaction under cash settled. When we meet in class, we'll use a question to explain further. The reading is important. All the best.